Beta risk is the one risk factor you don't want to be overly exposed to in this kind of environment. The reason GDP growth is so slow, the reason productivity growth is so slow at the moment is because we are at the end of the debt supercycle. I know you would like to ask me the question, how could I be wrong? But I can guarantee you that these megatrends will unfold. I'm a Danish national. Came home to my wife one spring day in 1986. I said to her, would you like to move to London? I've been offered a very interesting job. That's now 31 years ago. So we have now spent, we are for all intents and purposes British nationals, but obviously with strong Danish roots. I have worked mostly for American investment banks. I worked for Goldman Sachs for many years. I ended up at Lehman Brothers, heading up the private wealth management division in Europe. Then in 2002, I decided to start my own business, which is now into 17, 18 years. That business was mostly a multifamily office business. But gradually, especially after the financial crisis in 2008, we have increasingly become institutional. And today, the biggest client base for our business today is the UK corporate pension fund base. The end game could unfold in a number of different ways. But let me back up before we get to the end game. Let me explain why I think the world has changed quite dramatically in recent years. The typical investor today doesn't really care about the long term. For most investors, long term means next Monday morning and not next year or the year after. And therefore, some of the longer term structural trends that I have focused on in my book are being largely ignored and neglected by investors. And that's actually an opportunity set for those investors who are prepared to dig a little bit deeper and prepared to structure their portfolio according to what is going to unfold over the next 10, 20, 30 years. The end game can unfold in a number of different ways. If you go back to one of the six structural megatrends that I discuss in the book, is what I call the end of the debt supercycle. The last debt supercycle ended in the 1940s, late 30s, early 40s, and that basically reset the clock. Debt to GDP has been rising constantly since 1946, and I'm arguing in my book that we are now approaching the end of the current debt supercycle. If you go back in history, 200, 300, 400 years, you can find a number of debt supercycles. It's not an unknown phenomenon. We typically build up debt, something happens, everything collapses, and we start all over again. And that's precisely what we are at now. We are at the tail end of the current debt supercycle. That, combined with a number of other factors, will potentially end up in what I call the perfect storm, a prolonged period of low GDP growth, low returns on equities, and for that reason, investors need to think fundamentally differently in terms of how they structure their portfolios for many years to come. The way I structure portfolios, first of all, is quite different from the way most people do it. Most people think of portfolio construction as how much do I allocate to equities, how much do I allocate to bonds. They think of asset classes when they structure their portfolios. I don't think of asset classes, I think of risk buckets. I operate with 4 risk buckets: beta risk, alpha risk, credit risk, and gamma risk. And gamma risk is basically everything else. And what I think is important for investors to understand is that if the 6 structural megatrends unfold the way I think they will over the next several years, the worst bucket you can invest in is the beta bucket. Beta risk is the one risk factor you don't want to be overly exposed to in this kind of environment. However, the vast majority of investors are more exposed to the beta bucket than to any of the other buckets that I just mentioned. And therefore, you need to think very, very differently about portfolio construction when you take this into consideration. When you invest passively, you basically are exposed to what I call the beta factor. Do markets go up, or do they go down, or do they stay flat? The great advantage of investing passively is really to reduce your cost. On a pre-cost basis, active managers don't underperform. That's a myth, and it's a complete untruth. Active investors on a pre-cost basis perform in line with the market because they are the market. After costs, they underperform because costs to active managers is a significant factor in when you calculate total performance. When you invest passively, you obviously reduce your costs significantly, and therefore more and more investors have decided to invest passively because that way they can perform more closely in line with the market. Passive investing, you will basically buy the market. If the market goes up the way it has gone up the last 30 years, about 10, 11% a year, you'll be fine, but markets will not go up 10 or 11% per year over the next 20, 30 years. Markets will go up a fraction of that, if at all. I reckon that a global equity portfolio over the next 20, 30 years will probably do pretty much a zero return, maybe a very, very modest positive return, so anywhere between 0 and 3%, which basically means that if you invest passively, that's all you can hope for. If you invest in some of the strategies that I'll come back to later, you can improve those kind of returns significantly. We are 6 years into the current debt supercycle. We are coming to the very end of this. The reason GDP growth is so slow, the reason productivity growth is so slow at the moment is because we are at the end of the debt supercycle. Because the closer we get to the end, the more indebted the world is, the more capital is used to service existing capital, to service existing debt, I should say. And therefore, instead of using the capital we have at our disposal for productivity enhancing purposes, we use debt to service existing debt, and that obviously cuts back on productivity growth. The second one, and probably the biggest one, is the retirement of the baby boomers. Baby boomers are those who were born between 1945 and the early 1960s. The baby boomers have now started to retire in large numbers, and when baby boomers retire, you obviously reduce the size of the workforce, and when you reduce the size of the workforce, you reduce economic growth. I'm probably mostly worried about the retirement of the baby boomers, and let me tell you why. Economic growth, GDP growth, is a must in a world that is as indebted as the world is today. And with a declining workforce for many years to come, we know that economic growth will be very, very pedestrian. We know that the European workforce will decline by about 0.6% per annum, which basically means that unless productivity grows by at least 0.6% per annum, we'll also have negative GDP growth in the Eurozone. The US is by far the least impacted market by this factor. The US workforce will continue to grow by about 0.25% per year. The third factor of my 6 structural megatrends is what I call the declining spending power of the middle classes. Vast percentages of the Western world's population has seen a flattening or even worse, a decline in spending power over the last few years. It started in America. The Americans saw a decline in spending power. Then it moved to Europe, and the countries mostly affected in Europe over the past 10 years is the UK and Italy. And obviously, when the spending power is reduced, economic growth declines. And there's absolutely nothing on the near-term horizon that suggests that the spending power will improve anytime soon. The fourth megatrend that I have focused on in my book is what I call the rise of the East. But I'm less convinced that the rise of the East will actually lead to a decline of the West. It could lead to a decline of the West, but probably only in relative terms. As living standards improve in the East, as people start to spend more money, capital looking for good returns on the capital will increasingly look to the East for new opportunities, and therefore more and more capital will seek to escape from the West and look to the East for the opportunity set that is now being offered over there. And therefore, even if it doesn't have a major effect on GDP growth in the West that the East is rising, then it will definitely have an effect on the capital at our disposal, and that will affect productivity and GDP growth. Another structural megatrend that I have discussed in the book is what I called the death of fossil fuels. There is a very strong desire to electrify everything we do. Electrify transportation, electrify heating of our homes, electrify everything. And the death of fossil fuels is really a consequence of that other trend. Alternative energy forms are increasingly on the agenda for governments around the world. And alternative energy forms are perfect for electrification. And that will drive a even stronger need and desire to increase electrification. And that will basically kill the need for fossil fuels. But let me back up on that for a second. Fossil fuels won't die completely. Oil won't disappear, at least not in our lifetime. And the reason for that is the need for oil in the chemical industry. My last structural megatrend is what I called mean reversion of wealth to GDP. Wealth to GDP is a macroeconomic identity that many people are not aware of. Wealth to GDP in society all over the world is relatively constant. Wealth is basically the sum of all households, and the three big drivers of wealth in households are property, equities, and bonds. And total wealth to GDP in society, as I said before, is long-term constant. However, since the great financial crisis, where wealth to GDP came back to its long-term mean value, wealth to GDP has escalated out of control, so to speak. Today, in the US, where wealth to GDP is about 3.75 times, in other words, wealth is 3.75 times higher than GDP. Now, as of today, the number is about 5 times. So one could argue that wealth in the US will have to come back to by about 25 to 30% in order to get back to the levels that will re-establish the long-term mean value. If you go back, if you think about the logic behind this, it's actually quite simple. Think of wealth as capital and think of GDP as output. Wealth to GDP is then capital to output. In other words, how much capital does it take to generate 1 unit of GDP? And the wealth to GDP ratio then becomes a capital efficiency ratio. In other words, if the wealth to GDP ratio in the US is lower than it is in Europe, it basically means that capital efficiency in the US is better than it is in Europe. However, all over the world, we're now above the long-term mean, which basically means that either property, equities or bonds, or a combination of the three will have to come down in the years to come. Think about how they interact with each other. One could argue that the last one, the mean reversion of wealth to GDP, is actually the end game of the combination of all the other megatrends. It's a little bit different. It's not necessarily a trend. It's potentially more of an outcome that is a result of the retirement of the baby boomers, the end of the debt supercycle, etc. And therefore, I categorize the mean reversion idea or trends a little bit differently than I do the other ones. I'm probably more worried about people not paying any attention to this than anything else. I'm staggered, to tell you the truth, how ill-informed many investors are about these trends. They are all literally set in stone. I know you would like to ask me the question, how could I be wrong? But I can guarantee you that these megatrends will unfold. It's just a question of time. I don't issue many guarantees. My compliance manager will tell me that I'm not allowed to issue guarantees. But when it comes to structural trends, it's pretty much a given that they will unfold. And therefore, it's staggering how little attention people pay to it. The retirement of the baby boomers. One could argue that we could relatively easily fix that problem. I would be very surprised if any country around the world is prepared to go in the footsteps of Angela Merkel and do what she did last year or year before. To tell you the truth, it could fix an awful lot of problems for an awful lot of countries if we let in more immigrants. But there's no appetite for that at the moment. In terms of women joining the workforce, the numbers just don't add up. When we get to a ratio of women to men in the workforce, in the active workforce of about 9 to 10, so for every 10 men we have 9 women, the numbers flatten. The first countries in the world that reached this level of 9 to 10 was the 3 Scandinavian countries and Holland. And in all 4 countries, the numbers have flattened since. It doesn't go any further. So don't ever assume that for every 10 men in the workforce, we will have 10 women. It just doesn't happen. And therefore, if you look at where we are in other OECD countries around the world now, we are so close to the 0.9 number that you can't expect anything meaningful to happen on that front. The only country that is significantly away from 0.9 is Japan. Japan is a 0.7. So for every 10 men in the Japanese workforce, you only have 7 women. But having said that, if you then dig a little bit deeper again and look at the Japanese workforce, you will find that women under 40 are at 0.9, only women above 40 are at 0.7, which basically means that you would have to persuade the oldest Japanese women to join the workforce, and that is not very likely to happen. The Americans have something that we didn't really have in Europe called the echo boomers. The echo boomers are the children of the baby boomers. And for that reason, when we get to the mid-2020s, so 7-8 years from now, 9 years from now, the GDP growth rate in the US will start to pick up again because the echo boomers will start to kick in. In Europe, that won't happen, and therefore the slow economic growth that I'm predicting for Europe will last at least till 2050. It will fix a few things. Problem number 1, people don't want to work till they are 75 or 80. Working till they are 69 or 70 is not going to fix many problems. I know in Denmark, my home country, the unions are having a mega fight with the government at the moment, trying to persuade the government that don't take away from our members what they have earned over a lifetime. This is something they have earned over many, many years, and they are entitled to retire when they're 65. Don't touch that. And that is an argument that you hear again and again and again, not only in Denmark, but all over the place. So that's the first problem. The second problem is that old people are not as productive as young people are. Productivity peaks when people are in their 30s. Then it stays relatively flat for about 10 to 15 years. But when people reach their mid-50s, productivity growth goes on a steep decline. And by the time they are 65 or 70, they are significantly less productive than they are when they are at their best. So how long could this take before it all unfolds, before it all unravels? The true answer is that nobody knows. The pension industry in the Western world is divided up between defined benefits and defined contributions. In many countries around the world, defined benefits still account for a very significant proportion of total pension plans. In the UK, as an example, we have between state pensions, local authority pensions, and corporate pensions, the three main components of pension plans here in the UK. We have 10 trillion pounds of unfunded pension schemes, which is basically between 5 and 6 times UK GDP. Unless interest rates start to rise meaningfully, the UK DB pension model will collapse at some point. Given the enormous amount of unfunded pensions, I would say within the next 5 to 10 years. So could we survive with, not with GDP growth, but with GDP being relatively stable? I would like to offer two answers to that question. Extreme amounts of indebtedness in the Anglo-Saxon world, the lack of pension schemes amongst many citizens in the Anglo-Saxon world requires for GDP to grow, unless the ship will definitely sink. In the other part of the world, take Germany, where personal savings are extraordinarily solid and robust. I don't think we need GDP growth. The view in my family is that, yes, we will definitely survive without GDP growth. As long as we can protect what we already have, we don't need to improve things. But I'm sure you can find millions of people around the world who wouldn't subscribe to that view. And therefore there are different answers to that question depending on which part of the world you live in and how indebted you are. So what should investors really invest in given what we have just talked about? Let me go back to the 4 risk buckets that I mentioned much earlier. Beta risk, alpha risk, credit risk, and gamma risk. If I'm just about right that global equities in the years to come will deliver no more than low single-digit returns, the one risk bucket you don't want to be overly exposed to is the beta risk bucket. And that is, as I said earlier, that is the one risk bucket that everybody is exposed to at the moment. But let's start with the plain vanilla investor. Let's start with the investor who tends to invest in only bonds and equities. Bonds, I don't think belong in my portfolio to any significant degree. Bonds will deliver, at best, 0 returns, at worst, modest negative returns. I think interest rates will rise very modestly in the years to come, but not at all as dramatic as some people talk about. If I'm right that interest rates stay low for many years to come, investors will increasingly look for income in equities. And therefore, you should look at income equities as an alternative to growth equities. But let me put a warning flag in the ground right now. A lot of companies pay income without being able to afford it. A lot of companies take on debt to pay those attractive dividends. So you need to do your homework, but I would be very surprised if high dividend equities if income generating equities won't outperform growth equities over the next 10 to 20 years. Another option is to look at style as another factor. Style is really growth versus value. Growth has done spectacularly well against value over the last many years. As I expect a modest rise in interest rates in years to come, value should outperform growth. So that's the first reason. Second reason is that after many, many years of underperformance, value is now extremely attractively priced relative to growth and is at the very low end of the range. So for a retail investor, I would focus on those two factors, income and value. For the more sophisticated investor, I would look at other opportunities. One of my favorite strategies is what I call trade finance. International trade is increasingly between emerging markets and developed markets. And because of restrictions put on commercial banks are increasingly finding it difficult to finance that international trade. And that has inspired a whole new industry to pop up in the underforest of the alternative investment world called trade finance. The credit risk you take in trade finance is not overly dramatic, but you still get very attractive returns. Returns are on average 5, 6, 7, 8%, depending on which part of the world you look at, and you can typically access your capital in a few months' time. If you're prepared to go further out that curve, out the liquidity curve, and lock up your capital for 5, 6, 7 years, you can get even higher returns. One of my favorite trades further out the curve is aviation leasing, basically leasing commercial aircraft to airlines around the world. Given the growing living standards in Asia, more and more Asians travel by plane, and more airlines around the world choose to lease aircraft rather than buying them. And the reason for that is very simple. Commercial airlines need not to tie up too much of their working capital, and buying the aircraft ties up a huge amount of working capital, and therefore commercial airlines increasingly lease rather than buy. When I first joined this industry back in the mid-80s, only 3 to 4% of commercial aircraft were leased, the rest were bought. Today, it's about 35% of all commercial aircraft that are leased. And that is it's a trend that benefits from the end of the debt supercycle, it's a trend that benefits from the rise of the East, and you can get some very attractive returns, but the negative is you need to tie up your capital for 5, 6, 7 years. There is one risk that should never be underestimated. And I learned this in 2008. I learned it the hard way because I got burned myself. When the S ... hits the fan, the worst thing you can be in terms of your portfolio construction is that your duration of your assets is shorter than duration of your liabilities. In other words, you have a mismatch between assets and liabilities. In other words, if a trade finance fund offers quarterly liquidity to investors, but the underlying loan book is tied up for at least 6 months, then as long as times are good, as long as everything is hunky-dory, he can meet his redemption requests because there's always money coming in that he can use to pay the money going out. But the day we run into the problems we have talked about today, the day that we suddenly have to hit the brakes, then I can guarantee you there will be more redemptions than incoming investors. And when that happens, you don't want to have a mismatch between assets and liabilities. And therefore, I cannot warn investors strongly enough about this risk I learned in 2008 that this is the easiest way to lose your shirt in these markets if there is a mismatch, and therefore only invest in things that are properly matched when it comes to assets and liabilities. The problem we have today is that investors think that the sort of returns we have delivered or we have received since the start of the great bull market is sort of the norm, and that's what we should expect going forward. Nothing could be further from the truth. So rule number one, if we don't want to disappoint ourselves, is be realistic. Look at the long term. Look at what sort of returns have equities delivered over the long term, and not just in the last 35 years that have been extraordinarily benign for global equities. Secondly, construct your portfolio with the little twists and tweaks that we have talked about today. If you do that, I think you can do more than 2 to 3% per annum. You can probably do 5, 6, 7% per annum. And that should be enough not to make you too depressed.